If you think the next great fortune will come from finding one more obvious stock after it has already become socially respectable, you are thinking too late. That is the first truth. The biggest money is almost never made when a theme feels safe, widely approved, and easy to explain at dinner. It is made earlier when the technology still feels strange, the business models still look unfinished, the revenue still looks too small for the dream, and the price swings are violent enough to scare out almost everyone except the people who understand what stage of the story they are actually standing in. That is where quantum computing sits, and that is why this conversation matters. The public thinks the important question is whether quantum computing is real. That is not the important question anymore. The important question is whether you understand the difference between a civilization, scale technology wave, and the very different problem of making money from the stocks attached to that wave. That is the mother line. A great theme does not automatically produce great investor outcomes. A great theme plus bad timing, bad sizing, and no exit discipline can still leave people broke, bitter, and writing angry comments about a stock that once handed them life-changing gains. That is the deeper story inside the reference document. On the surface, it is a video about quantum computing, 3 stocks, and the tragedy of people turning 10 baggers into drawdowns. Fine. But underneath that surface is a far more important lesson, and it is one I care about deeply. There are moments in markets when the direction is right, the technology is real, the capital is flowing, and the eventual opportunity may be enormous, yet ordinary investors still lose because they do not understand how innovation actually travels from scientific breakthrough to commercial reality to stock market mania to brutal correction and then sometimes to much larger wealth later. That pattern is older than quantum. It happened with the internet. It happened with semiconductors. It happened with software. It happened with cloud. It happened with AI. It is happening again. The people who win are not merely the people who get the theme. They are the people who understand the rhythm. That is why I want to begin with the theme itself, before we ever touch the tickers. If you do not understand what quantum computing is really threatening, changing, and accelerating, then you will either underreact and miss the biggest commercial shift of the next era, or you will overreact and buy the first hot chart that gives you an emotional rush. Both are expensive mistakes. So what is quantum computing in the bluntest possible language traditional computers? Think through bits, 1 or 0, on or off. Yes or no? That model has built modern civilization, and I do not say that lightly. Everything around you rests on that architecture. But the architecture has limits, certain problems, especially in optimization, chemistry, materials science, cryptography, logistics, advanced modeling, and high-dimensional simulation begin to overwhelm even the most powerful classical machines because the number of possible combinations explodes faster than conventional computation can realistically handle. Quantum computing changes that structure, not by making ordinary tasks a little faster, by attacking a different class of problems altogether. That is the first mechanism I want you to understand. I call it problem class expansion. Most people hear faster computer, and that is already too weak a frame. Quantum is not just about speed in the ordinary sense. It is about accessing problem classes that classical systems either solve too slowly, solve too expensively, or cannot meaningfully solve at all within the time horizon that human beings, companies, militaries, and governments actually care about. The source document uses the image of reading every page of the book at the same time. Fine, it is an imperfect metaphor, but it points in the right direction. Quantum changes the search field, it changes the structure of the puzzle itself, it creates the possibility that problems that look computationally absurd under the old architecture become commercially solvable under the new one. That is not a side improvement. That is a regime shift, and once you see it that way, all the government money starts making much more sense. This is not venture capital fashion, this is strategic urgency. The source document is right to emphasize that governments are treating quantum much closer to the way great powers treat military technologies than the way they treat optional consumer gadgets. America is funding it, Europe is funding it, China is funding it, defense agencies are funding it, national labs are funding it, academic consortia are funding it. The exact dollar counts can move around depending on who tallies what. But the direction is unmistakable. Tens of billions are being allocated globally because no serious power wants to wake up in a world where another power is years ahead in computation that can affect encryption, materials, drug discovery, logistics, military modeling, and infrastructure optimization. That is the second mechanism. I call it strategic inevitability. A technology becomes extraordinarily investable when it stops being merely desirable and starts becoming unavoidable. The internet became unavoidable. Semiconductors became unavoidable. AI is already becoming unavoidable. Quantum is moving into that category. Not because every company in the space will win, certainly not, but because the world's most powerful institutions have already decided that not participating is strategically unacceptable. That matters enormously. It means the technology will keep being funded even through disappointing years, even through market crashes, even through public confusion, because the commitment is no longer only financial. It is geopolitical. That is a much stronger kind of sponsorship. Now, I want to say something that many people do not like to hear when the government decides a technology matters. That does not mean the stocks are ready. Those are different things. A nation can be right about the future and still invest very badly in the near term. Public markets are full of investors who confuse inevitability of the technology with inevitability of the chart. That is where most pain begins. And the source document gets this exactly right when it points out the great emotional betrayal at the center of the whole quantum trade. The stock picks could be right. The theme could be right, the returns could briefly be extraordinary, and yet a huge share of investors still end up disappointed or even underwater because they did not know what to do once the first vertical move had already happened. That is not a quantum problem. That is a market structure problem. This is the third mechanism. I call it innovation overheat. Every major technology wave contains a dangerous middle phase early. Almost no one believes. Then the first believers make a lot of money. Then the story becomes visible. Then the price outruns the near-term commercial reality. Then the stocks crash not because the technology died, but because the market temporarily got ahead of the actual monetization timeline. Then most ordinary people declare the whole thing was a fraud just before the real industrial build-out begins. That is the cycle. And once you understand that, you stop being shocked by the violence. The source document describes exactly that pattern in the 3 quantum names. It highlights early breakouts, huge runs, then brutal collapses. Some of these names went up hundreds or even over 1,000% from the earlier signal zone. Then they got cut in half or worse from their peaks. That is not a contradiction. That is what it looks like when public markets try to price a technological future, before revenue, scale, and execution have become clean enough to justify the first wave of euphoria. This is why I say the crucial question is not, is quantum real? The crucial question is, where are we in the monetization curve, and what kind of company can survive long enough to deserve ownership through the ugly middle? That is a much harder question. It is also the only one that matters. Now let us look at the 3 companies because they are not the same animal. IonQ is the revenue leader of the group, and that matters more than most people think in a sector full of scientific prestige and tiny revenue bases. Revenue is not just accounting. Revenue is evidence that somebody is paying for something real. The source document points to roughly $130 million last year and a sharply accelerating quarterly run rate, with the company projecting much more again this year. Fine. Whether the exact top line comes in a little higher or lower is less important than what the direction tells you. IonQ is not merely telling a story, it is commercializing one. That is a big distinction. And then there is the balance sheet, billions in cash acquisitions, supply chain verticalization through the Skywater transaction, defense, adjacent manufacturing credentials. A business that is not just building quantum systems in abstract, but trying to become the integrated American quantum platform company. That is a serious ambition. This is the fourth mechanism. I call it commercialization gravity. In early stage technology booms, money eventually begins to gravitate toward the company that can prove 3 things at once. It can generate revenue, it can survive long enough financially to keep building, and it can widen its moat through infrastructure, manufacturing or platform control rather than existing only as a research project with a ticker. IonQ is moving toward that profile. It is still expensive, it is still risky, but it is closer to commercial gravity than many of its peers. That matters because gravity wins. Eventually the market can be seduced by elegant science for a while, but over time it pays more for execution than for promise. Now look at D-Wave and the picture changes. D-Wave is interesting because it does not fit the public's default idea of quantum. It uses quantum annealing, not the more headline, friendly gate, model path most people talk about. That makes it easier to dismiss for people who have not done enough work. I never like lazy dismissal. The right question is not whether the architecture sounds less sexy. The right question is whether it solves economically valuable problems right now, with customers willing to pay for it and margins high enough to prove the solution is not a science fair project. That is where D-Wave gets interesting. Revenue still small. Yes, still losing money. Yes, but it has actual customers, actual systems, unusual gross margins, and a real claim to near-term practical optimization use cases where solving a real commercial problem today can matter more than winning a purity contest about which quantum architecture ultimately becomes most universal. That is a very important nuance. This is the fifth mechanism. I call it practical first adoption. A great deal of money in technology is made not by owning the company with the most elegant theoretical endpoint, but by owning the company whose version of the future becomes useful first in the messy commercial world as it actually exists. D-Wave may never be the canonical hero of quantum mythology. That may not matter if its systems keep solving real optimization problems for real customers, while the broader industry is still arguing about what the far future winning architecture will be. Markets pay for practical traction long before they pay for philosophical purity. That is why I never ignore practical first adoption stories. Now we come to Rigetti, and this is where the emotional temperature rises. The source document is clearly most excited about the risk-reward here, and I understand why. The revenue is tiny, the commercial profile is much less mature. On paper, it looks uglier than the others. That is exactly why the upside argument exists. Rigetti is not mainly a revenue story today. It is a technology and timing story, high-fidelity speed, fabrication control, important partnerships, public sector and international links. Hardware competence that, if it translates, could re-rate the company violently because the current commercial base is still so small. That is why names like this become so intoxicating. They offer what mature companies no longer can. Narrative asymmetry, this is the sixth mechanism I call it, technology optionality. A small company with weak revenue and strong technical promise often behaves like a long-duration option on future relevance. If the technology truly matters and the company's execution catches up fast enough, the upside can be extraordinary because the market has so little present-day earnings gravity to anchor the valuation. But the reverse is equally true if the technology lags, if funding tightens, if competition outruns it, if commercial conversion disappoints. The downside is ruthless. That is why these names are not investments for people who need emotional comfort. They are positions inside a technology thesis where the reward comes precisely because certainty does not yet exist. This is where most people begin lying to themselves. They buy the optionality but mentally price it as though it were already a stable business. That is how they get emotionally shattered. And this brings me to the most valuable lesson in the entire source document: selling. Everyone wants the next 10-bagger. Very few people want the rulebook for not turning a 10-bagger into a stupid experience. That is because buying feels heroic and selling feels like betrayal. People want to discover greatness. They do not want to think about exit structure while they are still intoxicated by the possibility of future greatness. But the market punishes that emotional weakness over and over again. It is one of the most consistent punishments in all of finance. The source text is correct that a person can pick the right sector, the right company, even the right entry zone, and still experience the whole thing as failure if he has no protocol for when the market hands him a gift far larger than the business has yet earned. The right to sustain, that is not greed alone, it is often confusion. This is the seventh mechanism. I call it temporary truth. In a violent growth stock run, price can briefly become truer than the long-term future and then less true again. In other words, the market can overshoot before the business catches up. The investor who believes every surge is permanent confuses temporary truth with enduring truth that is fatal in emerging technology names. A stock can go up 1,000% and still not be ready to hold that altitude if the next stage of commercialization needs more time, more capital, more proof, or more calm than the market's first mania allowed for. That does not make the company worthless. It makes the stock too far ahead of the business for that moment, and that is where disciplined selling matters. Now, I know the user's preference on this workflow. You want the original viral skeleton preserved, but expression, sequencing, and the internal long-form mechanics reworked. So the result feels like a finished independent piece rather than a lazy paraphrase. So let me be explicit about what the deeper skeleton here really is. The opening hook is not actually about Palantir or NVIDIA. The opening hook is about regret, missed money, life-changing money, the sense that you may have been right once before but were not positioned, not disciplined, or not early enough. That emotional hook is powerful because it instantly places the viewer inside a high-stakes frame. Then the source expands the thesis. Quantum is not hype because governments, laboratories, tech giants, and defense systems are all behaving as though this matters at a civilizational level. Then it names the three stocks. Then it reveals the betrayal. The stocks went vertical. Then they collapsed. Then the real lesson arrives. The picks were right. The exit discipline was absent. Then the source circles back to say the story is not over. That is a very effective structure. So here is how I would state the deeper truth in my own voice. The biggest investing mistake in emerging technologies is not usually being too early. It is being directionally right without a protocol. That is the whole thing. Because once you have no protocol, you become emotional prey. You anchor to the top. You mistake volatility for betrayal. You turn paper wealth into a grief experience. You stop seeing the technology clearly because your own chart trauma gets in the way. That is why I insist on separating the theme from the trade, and the trade from the holding strategy. If quantum is a decade-long theme, then there will be many entries, many exits, many fake starts, many narrative waves, and many periods where the best move is not to worship any one stock, but to understand which layer of the industry is becoming more commercially real. This is the eighth mechanism. I call it stage awareness. A great theme moves through stages. Scientific validation, government urgency, capital formation, early revenue, speculative overpricing, painful reset, infrastructure build-out, commercial selection, industry consolidation, mass adoption. The investor who treats every stage like the final stage loses perspective. The investor who understands the stage is much less likely to panic or hallucinate certainty right now. Quantum is real enough to matter, funded enough to continue, and early enough that the public equity expression remains messy, dangerous, and potentially extremely rewarding. That combination is rare. It deserves attention. It also demands humility. Now let me say something plainly. If you missed NVIDIA early, quantum may eventually offer another civilization scale opportunity. If you missed Palantir early, some quantum names may eventually deliver the same kind of multi-year asymmetry. But if you carry the same behavioral weakness into quantum that people carried into those other stories, then the size of the theme will not save you. A huge future does not save an undisciplined investor. That investor can still arrive late, buy the spike, fail to trim, fail to define risk, confuse the first mania with the final outcome, and suffer the entire thing as one more bitter chapter in the long history of being almost right. That is what I want people to avoid. This is why I care about the commercial hierarchy so much. IonQ looks like the most commercially mature of the group. D-Wave looks like the most practical first and near-term application specific. Rigetti looks like the most violent technology option on future upside if execution catches up. Those are different jobs, different profiles, different risk buckets, and they should not be mentally carried in the same way. That is a mistake too many people make. They buy 3 quantum stocks and tell themselves they are diversified. They may simply be holding 3 different volatility expressions of the same early theme. True diversification does not come from ticker count. It comes from driver count. If all the names are hostage to the same technology sentiment regime, then your diversification may be mostly cosmetic. That matters. So here is where I come down. Quantum computing is one of the most important technology themes of the next decade because it is no longer merely a science experiment. It is now a strategic, industrial, and geopolitical necessity. Governments know it. Defense systems know it. Big technology companies know it. That part is real. The commercial winners, however, are not guaranteed. The stocks will continue to be violent. The market will continue to overprice the first wave and underprice the eventual survivors in alternating cycles. And most people will continue to lose money in great themes because they still do not understand that selecting the theme correctly is only half the job. The other half is managing the life cycle of your own position. That is what this source document is really screaming about beneath all the charts and all the excitement. You can be right about the future and still get destroyed by the path. That is the hard lesson. And once you learn it, you become much more dangerous as an investor because then you stop thinking like a spectator, hunting the next hot name. You start thinking like an owner of risk. What stage am I in? What has the company already proven? What is still optional? What is already priced? What is my sell discipline if the market gets far ahead of itself? What is my threshold for admitting the thesis is delayed or broken? What am I actually holding here? A business, a technical option, or a momentum wave? Those are the questions that turn a good technology idea into a real investment process. Everything else is mostly excitement. And excitement by itself has made far more people poor than quantum computing ever will.